So we'll start with the payback method. So we'll see like how this works. Payback method, there are two ways to do it. So the first method is when cash inflows are constant, then you can use this method. So the formula works like this: payback equals to initial investment divided by annual cash flow. So the answer that you will get in is payback in years. That's what the answer refers to. Okay, so the selection criteria is select the project which has the less years. Okay, so the lower the better. So we'll do this problem. Calculate the payback period and indicate which project is to be accepted. Also explain the criteria to choose the payback, to choose based on the payback. So there are like two projects here, project X, Y. The investment is given, the annual cash inflow is given. So it is like constant. So that's what they have given it as a single number. So if it's going to be a differing number in each year, they would have given you that. But as it's the same number, the cash inflow is constant. So only for when the cash inflow is constant, we can use this method. And they have also given you economic life of that project. So we'll start for project X. Okay, so the formula works like this: 35,000 is the initial investment divided by the annual cash flow. You will get the answer. So the answer comes to 2.3 years, 2.33 years. And for project Y, we'll look at the answer. It comes to 15,000 divided by 7,500. So the answer comes to 2 years. So which one you have to select? You don't need to look at the economic life of the asset. That is not at all required. Okay, you have to just look at which project has the lowest payback period. So project Y has the lowest payback period, so select project Y. Okay, so that's about it. This 2.33 years can also be like found out like this. For example, 2 years and the balance 0.33, okay, refers to the month. So you can take it as 12 months. You can multiply it by 12. You will get an answer like this: 2 years and you get roughly 4 months. So this project can also be said as 2 years and 4 months of payback period. Okay, so the question will state you whether it wants in point like this or it wants in year and month. Okay, so based upon that you can work out it. We'll go to the next problem. So here we take payback in years when cash inflows are not constant. For this we don't have any formula. We have a table and we have to use that table to get an answer. So we look at it, but the selection criteria is the same. Select the project which has less years. A company has two projects of which only one can be selected. The cost of each project is 1 lakh. Use payback criteria. So they have two projects and we have to tell which project is better. So we'll start with project A. So project A, we'll do the payback. So we'll start from years, cash flow, cumulative cash flow, okay. So that's what we have to compute. Years is 1, 2, 3, 4 and 5. Cash flows are 50,000, 40,000, 30,000, 20,000 and 10,000. So you have to accumulate. So you have to add just the first year we get only 50,000. Next year we get 50 plus the 40 we get 90. So we accumulate it. The next year this 90 plus 30 gives us 1,20,000. We are just cumulatively adding it. 1,20,000 plus another 20 we get 1,40,000. 1,40,000 plus 10,000 we get 1,50,000. So we have cumulatively added it. So now we will work out the payback. So the payback works like this. First find out what is the total investment. The total investment is 1 lakh. Okay, look in which year it is crossing that 1 lakh. It crosses in the year second to third year. So it means that between the second year and the third year, the payback is situated. So minimum you need how many years? You need 2 years. Okay, minimum you need 2 years because you have to recover 90. So we'll again open a bracket. Total, what was the investment? Total investment was 1 lakh. Out of that, in the second year, how much have you recovered? You have already recovered 50 under 40, so 90,000 has been recovered. Okay. In the third year, okay, in the third year alone, how much of cash flow you're going to get? In the third year alone, you're going to get 30,000. So close the bracket. The formula is over. Okay, so 2 plus solve the inside. So 10,000 by 30,000. So 10,000 divided by 30,000 is the answer. So that comes to 2.33 years. So that is the answer. We got 2.33 years. Okay. Our job is like very simple. Ensure that you understand this formula. There is no explicit formula to be written for this, and no book has like specified that. Your job is to just understand the logic and get the answer here. If you want a better understanding, we can put it like this. See, in this 2 years, we have recovered how much? 90. How much balance we have to recover? Just 10. That is this 10,000. In the third year, okay, how much we are going to get? We are going to get 30,000. It means that within 0.33 of the third year, okay, 0.33 of the third year, we will recover the amount. So it is like in 1/3 of the third year, okay, in the 1/3 of the third year, we will recover the total 1 lakh. So that's what this works. So ensure that you understand. For project B, you try to do the answer. So if you want, I will tell you like how the answer would be. So without even doing the problem, we'll try to see like how it works. For example, 1 lakh has been invested. You have recovered 20 in the first year, 20 plus 30, 50 in the second year, 50 plus 40, 90 in the third year. How much still you have to recover? Just 10,000. So 10,000 divided by 50 gives you 0.2. How many years you have taken? You have taken 3 years. So you have totally taken how many years? From here to here you have recovered 90,000. In the fourth year you have to just recover 10,000, but you get 50 in the fourth year. So just 0.2 of 4 years is required. So project B should ideally take you project B should ideally take you 3.2 years to recover the amount. So that is the payback for project B. So you guys try to work out this and try to get the answer for it. Okay, we will move on to the next problem. So here's another problem which is like very similar to the last problem, but there is a difference here. A company is considering an investment of 4 lakhs in a new machinery. The machinery is expected to yield incremental profits over the next 5 years as follows. Okay, so I think we'll strike off the word incremental, that is like not correct. Okay, so expected to yield profits over the next 5 years as follows. So these are the amounts you got, but it's profit. When compared to the last problem, there was like cash flows. So payback always deals with cash flows, not profits. If the question specifies you profit, you have to convert the profit to the cash flow. So how do you do it? See, normally what happens is when you get profit, okay, and then you add the non-cash expense, okay, any non-cash expense, if you add, you will arrive at the cash flow. So that's how it has to be like computed. So if they have given profit, they would have given you some kind of a non-cash flow expense, add it back and you will get the cash flow. So we'll read it. Thereafter, no incremental profits are expected and the machinery will be sold. It is company's policy to depreciate machinery on a straight line basis over the life of asset. The machinery is expected to have a value of 50,000 at the end of the 5 year. Calculate payback of the investment in this machinery to the nearest 0.1 years. So in this problem, before doing the payback, we have to find out the profit. So what we'll do is we'll start from here. Okay, So we have years, we have profit. Okay, with profit we have to add the non-cash expense. In this sum, the depreciation is the non-cash expense, so we'll add the depreciation back and then we'll get the cash flow. So we'll have year 1, 2, 3, 4 and 5. We'll add the profits. Profits are 1,75,000, 2,25,000, 3,40,000, 1,65,000 and 1,25,000. So we have to add the depreciation. So our depreciation, we'll do a separate calculation here. So depreciation equals to the value of the machinery. What is the value of the machinery? Minus scrap divided by the number of years of machinery. So the value of the machinery is 4 lakhs minus what is the scrap? The scrap value is 50,000 divided by total life of 5 years. You will get the answer. So 3,50,000 divided by 5 will give you 70,000. So 70,000 per annum is the depreciation. So add 70,000 to all the numbers here. You will get the cash flow. So what is our cash flow? Our cash flow is 2,45,000 here, 2,95,000 and 4,10,000. I think we will stop that. We don't need to proceed further there. We'll work out the payback. So we have to find out the cumulative cash flow. So cumulative cash flow is 2,45,000. Add this, you will arrive at this number at 40. Okay. See, we don't need to do the full table. Whichever year we are going to cross the 4 lakh, the investment, we can stop there. Okay. So we don't need to continue further, and we don't need to like keep on doing the problem over a period. So what we can do is the investment of 4 lakhs is recovered between these 2 years. So we'll find out the payback. So the payback equals to how many years? Minimum you need 1 year to recover the amount. Okay. How much you have invested? You have invested 4 lakh. How much you have got in the first year? You got 2,45,000. Okay. How much you are going to get in the second year alone? In second year alone, you are going to get 2,95,000. Solve it. The answer comes to 1 plus 0.525. So it's 1.52 years. Okay. So the answer requires you to put it in 0.1 years. So after decimal, they need just one number. So after decimal, we have taken even two numbers. Okay. So that's about the answer. So first to work out, solve this part. The answer comes to like 1,55,000. Then divided by 2,95,000. So you got the answer. The payback is in 1.5 years.